This video is going to cover the topic of audit risk. The aim of this video is to gain an understanding of the factors that must be considered by auditors when deciding what is an acceptable level of risk associated with a client. The definition of audit risk is the risk that the auditor gives an inappropriate audit opinion, i.e., there are material misstatements present in the financial statements. Before we go into the practicalities of audit risk, let us ensure we understand what material misstatements are. This is defined in ISA 450 as a difference between the amount, classification, presentation or disclosure of a reported financial statement item and the amount, classification, presentation or disclosure that is required for the item to be in accordance with the applicable financial reporting framework. Misstatements can arise from error or fraud. This is a very wordy definition and difficult to remember. To help remember, we could summarise as follows. A misstatement is the difference between what is in the financial statements and what should be in the financial statements in accordance with the applicable financial reporting framework. These material misstatements, if present in the financial statements, could cause inappropriate decisions to be made by the users of the information. For example, a decision could be made by the bank to give finance to the company based on the financial statements. In reality, if a material misstatement is present in liabilities, causing them to be understated, once corrected, the lender may not come to the same conclusion. If there are material misstatements present and the auditor states in their opinion that the financial statements are true and fair, then their opinion is wrong. This leads to users making incorrect decisions, but also could lead to others questioning the auditor's competence, therefore affecting their reputation and future client relationships. The aim is therefore to keep audit risk as low as possible for every client. Auditors must identify the risks associated with the client at the planning stage of an audit. To calculate audit risk for each client, they use the audit risk model. This is shown as follows. AR, which stands for audit risk, is equal to IR times CR times DR. Each of the three components of audit risk in the model need to be considered by the auditor to decide the level of risk. IR is inherent risk. This is the risk of a material misstatement in the financial statements due to the nature of the client, whether it be the business itself or the industry which they operate within. Inherent risk may be high due to the level of regulation that must be followed by the client. If heavily regulated, there is a stronger risk they may have not followed industry rules and disclosure in the financial statements may be inadequate. It could also be related to what they trade in or produce, for example. If the products are frequently being improved and replaced by new products, there is a risk inventory held in the financial statements may not be valued correctly, leading to material misstatements. Clients trading in technology are always high inherent risk clients. The auditor cannot change the level of inherent risk. They must identify it and then plan how to manage it. CR is control risk. This is the risk of a material misstatement in the financial statements due to poor client controls. Control risk may be high due to the financial reporting system itself. For example, it may not be integrated with other systems which provide it with information. If human input is required, this increases the risk of misstatements being present. Control risk may also be high as the client does not perform adequate control procedures within their business. To give you an example, if the client does not perform a year-end inventory count, it increases the risk of the inventory balance being materially misstated. Again, the auditor cannot change the level of control risk. The auditors can recommend changes for the future. For now, these issues must be identified to decide the level of and type of audit work needed. DR is detection risk. This is the risk of a material misstatement in the financial statements due to the auditor not spotting the error. This is the one element of the audit risk model that the auditor can do something about. The auditor must ensure that their audit procedures carried out during the audit process are able to detect misstatements that could be material. The level of work needed will depend on the client's circumstances. If the client is imposing a tight deadline, it may mean the long working hours could cause misstatements to be missed, or the auditor may cut corners to get the work completed on time and perform less procedures than they should. If the client is new, the audit team may lack knowledge of the business, which could mean they miss something important in spotting a misstatement. So we can see that inherent and control risk cannot be changed. The auditor therefore needs to identify these risks, which will then help them decide what the detection risk level can afford to be. This audit risk model needs to ensure the overall audit risk is kept as low as possible. If the auditors have a tricky client and inherent and control risk are high, then detection risk must be low. The only way to reduce detection risk is to increase the work carried out on the audit. More audit procedures would be needed. More time should be spent on the audit. Sample sizes should be increased, and even more experienced audit staff should be used to help detect material misstatements. If the client is a fairly stable one with no previous or current issues in a non-risky industry, then detection risk can afford to be a little higher. This does not mean the auditor relaxes the rules when carrying out the audit work, as they still must follow auditing standards and ensure they have collected sufficient appropriate evidence to form their independent opinion. What it does mean is that they can afford to test smaller samples of transactions and therefore spend less time on the audit in comparison to a more high-risk client. The audit risk model is key to understanding audit risk. The three components, inherent risk, control risk and detection risk, identify the overall risk of the auditor forming an inappropriate opinion on the financial statements. Remember that the nature of the client's business and industry and the quality of their control systems could cause material misstatements, and these risks must be identified by the audit team at the planning stage. They then need to decide on the level of acceptable detection risk. For detection risk to be low, more audit work and time spent is needed by the audit team. This all then helps decide on the audit procedures needed to be carried out and the key financial statement balances that need most focus. If audit risk is assessed correctly, the audit opinion will be appropriate at the end of the process. I hope you found this video useful. Thank you for watching.